Hey, welcome back to the show, everybody. And every once in a while, we come up with something that's, I don't know, like kind of fun. Statistically, just what? Anyway, so we're going to go through the headline today. Homeowners would rather take less money than to sell to their ex. You're like, what? All right, let's get into that. Okay, so here's the funny thing. Like I say, every once in a while when we're out, making sure we're taking a look at metrics, taking a look at new titles, what's happening nationally as far as some trends, in fact, even, chatting with the feds a little bit. What the heck were these stats? In fact, we got a couple of them. So let's bring them up. The funniest one, what do you guys think the number one stat was for not selling your home? Well, here it is. So the percentage who would take an offer below asking price instead of selling at asking price. Well, the first one, a buyer who was very rude. So let's delve into this. Here we go. So a third, 33%, would turn down a significantly higher offer if they knew that the would-be buyer was going to knock down or completely renovate their home. Now, I can attest to this, and it is super interesting when we talk to folks, especially when they have a ton of sentimental value in their home, because they're like, "Hey, man, I don't want to sell them because I know they're gonna completely change this house, or they're gonna knock it down, and I don't want them to do that because they have that sentimental value, in which that is a thing that only you have, and a lot of sellers struggle with that sentimental value. They say, well, my house is worth more. Okay, well, why do you feel it's worth more? And that's exactly it. What do you feel? Because the metrics we just showed you are inconsistent with what you're saying. So anyway, just saying. All right, so let's get back to this. Here we go. Roughly 40% of people would not go through with a sale if they didn't like the buyer, even if the offer was much more than expected. Again, I have totally experienced this, and there are sellers that will take a lesser offer. They say, well, I just didn't like that. I didn't like what they said. I didn't like the vibe they gave me. And it's super interesting because, again, this is very consistent, with things that we've heard. Not every seller. I mean, it's not every week or every month, but it is enough that it is funny, and it does come to point. All right, let's see here. Over half, 53%, would take an offer below their asking price to avoid selling to a buyer that they felt was rude. That's 58% of women and 47% of men. Now, here we go. Nearly 1/3 of homeowners, 31%, would take, I love this, would take a below asking price offer over selling their home to their ex at asking price. And in fact, 1 in 8, 13%, would actually take their home off the market if their ex was considering buying it. I think that is absolutely hilarious. Now, if you're one of those divorcees and you're watching this, you're like, dude, that is not funny. Well, okay. It kind of is because it just is. All right, we'll just let that one ride. Let's get on with the rest of the show. So a lot of things have been happening in the market. In fact, let's take a look at some of our headlines here. So we had the big bounce in the refi demand, and that is because rates have been heading in a downward trend consistently, even though, funny enough, even though we have had a little bit of a uptick because of some of the information that was coming out this last week, since Wednesday. So rates kind of started to ride back up again, but Friday, we started to head back down again, because the investors were doing well. Part of it was the presidential speech that he gave and some of the blowback on that and a few other things. And the market really didn't care for it a whole lot, so it made its adjustment, but it started coming down. And what's super interesting is that when we start taking a look at what the feds are going to do, I believe they're meeting on the 17th of this month. And if that's the case, I don't expect them to lower Fed rate, okay, which has nothing to do with mortgages, which means that our pricing should continue to head downward. We've been into about the 6.5, 6.7, 6.6, 6.5. And with that, we actually have a number of different good positive numbers helping buyers. And we have seen some of that, and you're going to see those metrics here momentarily. So when we pop this back open again, here we go. We've got home price growth, probably the last thing to worry about. There's a lot of other things that are in our marketplace that we need to be mindful of. And then, of course, we've been seeing a tick down towards the lowest rate that we've seen in the last 4 months. And that's super important because as we are going through each of these weekly metrics for you, just understand these are local numbers. We're dealing with residential only. We don't care what's going on nationally. We only care what's going on here. We will pull in national information because we will see what will that do with trends. All right. So when we take a look at it, let's take a look at rates. When we talk about Freddie Mac, one of our bigger lenders that are out there, there's a little bit of latency that's going on because my screen is not changing here, and I'm not sure why. Anyway, so there we go. When we take a look at the Freddie stats, look, we're already a quarter rate less than where we were a year ago. And more importantly, we are about a third less than where we were at last week. You can see that we are definitely trending in the positive territory, which is actually super important. Now, if we take a look at the next chart here, hang on a second, and we see that our average days on market and our average list price, as far as list to sales price, look, we're at 100%. We were at 98 last week. We're at 100% this week. Our market times are down 2 days. Now, that is super important. And you might be saying, okay, why is that super important? Well, listen, when we take a look at all of the elements of what's happening each and every week, when we can see, hey, we listed at $100,000, we sold at $100,000 versus we listed at $100,000 and we sold at $98,000. Okay, buyers and sellers weren't agreeing, but now they are, and in fact, we are seeing multiple offers come back into the marketplace a little bit more aggressively than what we expected. We have seen some pretty aggressive escalations from different buyers out there. Make sure that you are only competing with yourself. Now, when you take a look at what's going to be going on with the market watch itself, our 7-day running average, okay? All right, here we go. When we take a look at what came on market, we saw 960 homes that came on market. Then we have 1,104 that went pended. Okay, so what that's telling us is that we're still taking off more homes that are going off market, meaning going pended, going under contract, than what came on market, the average of the last 7 days. Now, this has been a consistent pattern really since, well, I would say the last 12 to 14 months. And even though we do have some of that cycle, our inventory is only about 49% of where it should be. And that is, well, that's getting a little bit on the light side. If we pop over and we take a look at the comparison, we take a look at what happened last week. So last week we had 823 that came on market. Oh, we had 969 this week. Okay, that's great. Last week we had 1,006 that went pended or under contract. This week we had 1,104. Excellent. Both weeks you can see that there's back on market, meaning sales that failed. And those are great opportunities for buyers. Okay. That's a, hey, the seller lost their buyer. You should go out and re-engage because there's a high probability that you can get a better price. Sorry, sellers, but the reality is if a seller just went back on market and they're like, oh God, I just lost my buyer. Boop, they know, hey, I have a new buyer. There's a higher probability you're going to get a better price or at least better terms. Just keep that in mind. All right. Now, when we start talking about the actual metrics of what's going on in our little real estate world, we take a look at what is happening as far as the active price, the average active versus the average sold price. Super important because, again, it helps us with trend. Trend is also a friend. Hey, do you like that? It's a rhyme. Anyway, here we go. So when we take a look at the year to date, which is the top chart, look, we were $9,000 higher average list price than where we were at last year, or last week, I should say, about 2.9 or basically 3% less year over year. But our solds are $3,000 more than what it was last week. And of course, we're looking at about 3% above average sold price year to date, year over year. When we take a look at just the month of March, again, month of March, it's 9,000 over list price. So we're listing at a higher price, still 3% less than last year. The howevers, we're up 11,000 over last week, and just a shade over where we were at last year at this time. That's super important. As we look at trend, as we start taking a look at our spring market, which is seasonally normal, when we start heading into what would be the March, April, very aggressive market timelines for our spring market, and with interest rates coming down, I can tell you that the number of showings that are out that are being registered is up. I want to say it's almost like 18%. It is a significant number, and will probably continue to increase since today is, well, technically these are March 7th numbers, and today's the 8th. By the way, it's raining, and be careful out there. Stay warm. All right. When we take a look at our next chart, when we actually start talking about velocity, our numbers, even though we're just a tad, 3 homes, less on market than where we were at last year, we're off for the month of March by 93 homes. That's the center chart there. So we're less 93 homes, but go to the right year to date, we're actually up. Actually, I think I have a better chart here for you. There we go. We're 202 homes above the sales volume that we had at this time last year, or basically 2.6%. Now, the whole point of taking a look at all of these numbers, first of all, you can see that we're at like 8,000, and some of you might be saying, oh my gosh, George, that's a lot of homes. No, it's not. We should be like 14,000-ish. As we get into summer, we should be the 18 to 22,000 homes. And that is why we talk about, hey, over the last number of years, in fact, I've got a really good chart for you. When we talk about inventory, we take a look at the last 10 years. This is the number of homes for sale on average, and it goes back to 2015. Now, you can tell that 2020 through 2022, those were very unique. We will set those aside, kind of like the 2008 and 9. We set those aside. And you can see that our numbers are just really low comparatively to where they were at, 2017, 16, even 2019. You can see that we are significantly less as far as homes available. Now, again, do I think that our market is just starving for inventory? No, actually, I think we're very well balanced. We are not seeing massive swings in either way as far as homes going pending or under contract or homes coming on market. We don't see massive disparities in that at all. Now, you might say, well, George, there's almost a 2-to-1 ratio on the Wednesday stats. That's okay. That does not matter. And the reason I say that doesn't matter is because that is normal, because Friday's a massive list day. But when we average the two, we have a balance of homes coming on market versus going off. Having 2.5 months of inventory has become our new norm over the last 10 years. And so if we started to see a massive increase in inventory, yes, the buyers out there will match it, but only to a degree. The 4 to 6 months of inventory is not a balanced market anymore, in my humble opinion. I think that is just too much inventory from what we've seen. All right, moving on. Let's take a look at new construction. So new construction itself, they have been playing a little bit of catch up. They had a absolutely drag as far as coming online with inventory in January. They struggled a little bit, and they've been playing a little catch up. In fact, let's roll our chart over here. So when we take a look at it, average sales price, last week it was 974. It's 976 or 966 today, but we are still year to date 5.2% higher than where we were at last year. All right. when we take a look at the month of March, last week, we were at 937 as an average sales price, average list price, $1,025,000. However, right now it's $1,021,000. So we saw a nice bump in activity as far as actual pendant. And that's going to just, bounce back and forth consistently each and every week because prices go up and down. Now, that doesn't mean, oh, my house is worth more today. No, it's worth less today. No, it's worth more today. That's not it at all. It's the average of the solds. And we take a look at market times. We take a look at how that is trending and what is the number of homes as far as velocity goes. And let's talk about that next. So when we open up that chart and we look at this, we're like, oh, okay. Well, even though our prices went up, you know what? We're still down about 22 homes for the month of March. Pendant down 21, but also we're about 25% short, which is about twice as many of when sold as far as new homes on market, right? So if I go over to the bigger chart for the year to date, look, we're down almost 7% as far as new homes on market, and we're down a total of 183 homes year to date, pendant or under contract, 289. All right, well, you might say, George, what does that really mean? Okay, what it means is those numbers have been improving since January. January, man, they were dragging, but they have been making up ground consistently. Part of that is better rates. Part of that is the less inventory that is available out there. Part of it is incentives that are being offered by different builders when people can still get a 4.99, right? 5% mortgage, which would be permanent, which is a buy down. So there's a lot of incentives that are out there, and they're not willing to play a whole lot with plat pricing. Well, if you owned there, you would want to make sure that they didn't. And any future sales, you want to make sure, again, that they weren't, slashing prices. We're not seeing that in our area. We see the consistent incentives that are being offered to buyers. All right, let's move it on. When we take a look at my favorite subject sometimes, which is REOs. REOs, super boring, although their numbers this week are hilarious. Why are they hilarious? One, because as you can see, we really don't have much inventory at all, okay? More importantly, when we take a look at this, look at that. For the month of March, pendant up 233%. That is hilarious. Why? Well, we went from an average, last year we had 3 pendant, this year we had 10. Again, make sure that when you are getting quoted statistics or you're looking at statistics, right? Because remember, there's lies, there's damn lies, and then there's statistics, right? So when we take a look at statistics for REOs, the numbers can be absolutely skewed. And if you don't understand the real numbers that are supporting them, well, that can be a little misleading. Back to the show. All right. So when we pop this back open, you can see, okay, so we had 11 homes that came on market. Technically, it was only 9, 2 are mismarked. And we had 3 more homes come on market year to date than we did last year, which is, as you can tell, that's nothing. Pendants and solds, those are up year to date, and especially the pendant for the month of March. However, look at that, 40% less sales because, well, we have 3 for the month of March and we had 5 last year to date. Again, understand that is just nothing. So if you have any questions, put them down below. Would love to hear what you guys have to say. Have an absolutely beautiful weekend. And in the meantime, I will see you guys on the next video. And make sure you smash that subscribe button. Let us know you like it. And then, of course, we always respond to you in, well, typically under 30 minutes, except for on Sunday. Have a great day, guys. I will catch you later.